Joining us now with more from Beijing, Ben Harburg, managing partner at Beijing-based VC firm MSA Capital. Also with us is Safanad, chief investment officer and CNBC contributor, John Rutledge. Good morning to both of you. Good evening, I guess. Ben, let me start with you on how this is playing over in China. You're under the impression, you feel strongly that this is not a good move by the Trump administration and that it will not be effective. Why do you say that, and do you allow any room for the possibility that this pressure could result in a breakthrough we haven't had before?
Listen, the challenges of forced technology transfer, IP protection, these are legitimate issues that the U.S. government has with China, but the problem we've seen is that the Chinese government, when they want to come to the table and speak pragmatically with the U.S. about these issues, have been rebuffed by these measures of what we call extreme pressure locally. And the net result is that they don't have anyone to negotiate with. There's no set of clear policies and standards to bring to the table. It's really just ships passing in the night right now.
So, John, what does get us to a different place? Because the types of negotiations we've had in the past have been ineffective. The WTO, it hasn't managed to get done through those channels. You also argue that this is not the way to get this done, but how do we get to a better point if not these tariffs?
Look, what we need is more open trade. We need to have more open markets. Intellectual property protected is a good thing. But I don't buy the idea that we start out that somehow all of history has failed, so we have to do something radically different. Trade is extraordinarily complicated, and supply chains are complex. If you're not careful and you trip up a supply chain, a single part in a single factory missing at the wrong time will shut the whole thing down. So we've got to be more careful about what we're doing here. Obviously, we would like to have more open financial markets, but tariffs aren't always the way to do that. And if you always respond to the other guy by doubling down, you're putting him in a spot where he's got a lose-lose back home. Xi cannot afford to look like a weakling in the face of this kind of public pressure. These things ought to be done in private, not in the press.
That's how I believe we've done it in the past, John. I'm very interested in you reject the premise that the methods we have tried before have failed. Why do you reject that when they ascended to the WTO? We expected less bureaucracy and more democracy, and that hasn't happened, actually, and it seems to have gone backwards under Xi. You really think that the process that we were using for the last 30 years has worked?
Well, absolutely, it's worked compared to where we started. It just takes time to do it. Xi is a different cat than Hu Jintao was. That's absolutely sure. But he's a different cat in a much less democratic and more autocratic way. He's a virtually emperor of China now. And so he is not going to be a guy that's easy to deal with in public if you embarrass him. And in terms of what has or hasn't worked, it's incorrect to say that because we have a trade deficit in physical goods, that somehow implies that there's a terrible thing happening. We sell goods, we sell services, and we sell assets, investments. All three of those things always balance. So the question is, what do you sell? And this manufacturing focus of trade in goods leaves out all the other components of trade. It just doesn't make any sense.
Mm-hmm. But Ben, your company invests in both U.S. and Chinese technology companies. How good is the quality of Chinese technology innovation these days? I ask the question because whatever attempt to rebalance that the president is doing, is it too little, too late? Is Chinese technology industry already as good as the U.S. one?
Certainly there are flaws in the Chinese technology base. I think the ZTE moment for many of us was, we would call it a Sputnik moment. It exposed that a lot of the investment here has typically gone into later stage consumer internet, of relatively low technical barrier entry businesses. And so it exposed the need for China to develop it's smart manufacturing, robotics, AI, core technologies, the kind of things that are being emphasized in China 2025. And the view locally is that actions like these kind of tariffs will only spur greater incentives locally, accelerate the process of building out those types of centers of excellence, financing businesses in those sectors, and growing a local base of chips and technologies that will ultimately enable it to reduce its dependence on the United States. And so we view this moment as quite pivotal, and we think that ultimately it's only going to damage the dependence of China on these U.S. technology inputs down the road.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.